We're here with Christophe Ruhl of ADIA, the Abu Dhabi Investment Authority. Thank you, Christophe, for joining us. We've heard debates about the oil markets all day. Christophe, I'd like to ask you, in light of Opec's strategy of letting markets rebalance themselves, would you say that strategy is working?
I never quite understand what it means letting markets rebalance, but as a deliberate strategy of moving away from production cuts, which they adopted in November 2014 at the Opec meeting, in response to both falling prices and falling Opec market share, I think it was a rational strategy, economically speaking. I think it is working in the sense that we're seeing supply reactions. We have to distinguish, of course, between those cuts in capital expenditures, which are happening now but will become visible only 7 to 10 years from now. The conventional oil cycle, large projects which have a long gestation periods, and where today's cuts become visible only much later. And the immediate target, which certainly is US shale production, which has a much higher ratio of operational expenditure and is much more flexible. And there we now seem to see the first results. I think from the perspective of large oil producers organized in OPEC, it probably was not the best thing in the world which has happened to them, but given this large increase in the US, it was a rational response, and so far it is working. But the big question, how resilient really shale is still outstanding. So I missed that a little bit in the morning discussion. There were people saying, anticipating your next question, there were people saying that shale is just like the rest of it and is not as resilient as they think. The test is yet to come. Because, of course, when you plunge oil prices down 50%, there will be consequences for production. We know that costs follow prices, but we also know what happens with a lag. So now prices have plunged down. There is the first consequences on the rig count and on production. But the litmus test whether shale is really different or not will come when prices pick up a little bit, maybe later this year on a little hump. And it will be the answer to the question, so how flexible is it really? How fast will it respond to higher prices? How important is the frac lock, this new English word in the English language, denoting all these wells which apparently have been drilled and prepared but not yet fracked? In other words, if there is a price hump, as many now predict, how quick will the shale response be? That's when we will see, and that's the first time it's happened, so nobody knows. That's the real possibility of an inflection point, and that's when we see how resilient shale is, and if there really is now sort of a shorter term cycle in addition to the old 7 to 10 year old cycle, which we have seen dependent on these cuts in capital expenditures of conventional oil producers.
Let's talk for a moment about the Paris climate talks that are coming up later this year. How should oil producers position themselves for those climate talks? And what kind of consequences do you think there could be, depending on the outcome in Paris later this year?
There is a triple problem here. I mean, the first one is that still today, many of the advocates of hard carbon restrictions who don't realize to what an extent the global system is actually dependent on fossil fuels. In other words, there is the danger of overreach and of becoming unrealistic, and then they're disappointed. I think one of the real reasons why many people moved away from this whole debate is that too many promises were made too early on the degree which cuts could actually be implemented. And if you tell people, if you give them wrong information and you promise them more than you can deliver, that's what you get, people walking away from the debate. Secondly, there is this thing about carbon in the ground making companies valueless. I think this is a really sort of double dangerous, a bit silly discussion, because last time I looked, at least in a market economy, it was up to investors to decide whether to invest in a particular company, the wealth of which may be based on reserves in the ground. So it's a market regulative here. It shouldn't be up to regulators or politicians also to interfere here and saying you are making a mistake, the investors. Setting a regulatory framework means to say either you can invest or you cannot invest, but not influencing it through. That is, I think, a bit of a bad approach. And then thirdly, I think it is very important, of course, for the industry to get involved on that and stop denying and see what can actually be delivered. So I'm a great friend of not regulation so much, but carbon prices, and harnessing the most effective force we know, which is market forces, to solve that or to tackle that problem. Solving it, unfortunately, will be extremely difficult.
Let me ask you a last question about Oil and Money Day 1, which is coming to an end just now. What's your impression of today's discussions, and why did you decide to participate in the event, which I know is not the first time?
I think it's a great event. I've been there many years. What makes it distinct, you could observe that today, is that there is an audience which actually doesn't walk away after the first session or after the top line speaker has been spoken, and that there's a high degree of concentration in the room when people ask questions and get responses. And so it's a bit of a more serious thing. And that has to do, I think, with the kind of mixture of attendees which has grown over the years, which is a good one.
Thank you very much, Christophe Ruhl of the Abu Dhabi Investment Authority, ADIA, for talking to us.
You're welcome.
Thank you.